Hey everybody, welcome to Friday's Roundtable, Wealth Press Roundtable. I'm here with Roger Scott. Roger, welcome.
Thank you, James. It's a pleasure to be here with all of you.
You bet. That was quite a day in the market yesterday, Roger. What do we make of that?
Well, it kind of goes back to a lot of what you and I have been talking about the last few weeks. As a matter of fact, I did a video and I said, I hate to say I told you so, but this was coming. The only surprise I would say is I was actually expecting these conditions to linger on for another week or two before we saw what we did yesterday. So it actually happened faster. But look, it's just a simple case of too much too soon. I had a perfect picture actually. It was in the LA Times, and there was a picture of people in Venetian Casino in Las Vegas with a headline on top: coronavirus? What coronavirus? No masks, nothing. And it's just, and that's exactly what the market reminds me of. It's just people don't seem to appreciate or comprehend the severity or the potential severity and the length that this can cause a major unfooting in the market. And it's blowing my mind. We saw it with the energy market in the beginning of the week. I'm sure you've seen Chesapeake Energy and a couple of other companies. Energy started taking a dump, and now the market. And it took the Fed. It took two things. It was the Fed telling us, "Hey, people, wake up. We're not where we were. It's going to take us a little while to get out of here. Nothing is rosy." That was number one. And the simple fact that we're opening up things too soon, and there's a lot of states that are showing some significant signs of reinfection with no vaccine on the horizon. So it's kind of like doing the same thing, repeating the same thing, and expecting a different result, if you will. Which is definition of insanity. That's really all there is to it. I mean, I know a lot of people are looking for a trigger, but honestly, it's just a continuation of what we saw. And lastly, before I sometimes can go on these talking tangents, but again, this confirms to me that this is not a new leg up. This was just a reaction to the downshift that we saw in February and March. And I believe the market is now the second shoe is about to drop, or is dropping right now as we speak.
Okay. Yeah. So, I mean, I've become a little bit more cynical of the market, if that was even possible. And so I'm with you there. When you say "told you so," when they started talking about reopening the economy and subordinating the interest of public health to the economic interests on a national level, it was like, well, we agreed that was premature. We have the lesson of 1918 to remind us that just as then, opening the economy too soon is going to induce a second wave. And I guess that market reaction is that expectation. But is it safe, do you think, to expect then that, okay, in the context of the way markets work now, that an 1,800 point drop yesterday, there's no reason to believe that there's going to be anything more than a brief market swoon before the party gets started again, because the expectation is going to be that, well, we're going to have another round of money printing and quantitative easing, and so all that's going to go into the market and drive asset prices higher, so we may as well load up the boat. And that's really the position I feel like I'm in right now. It's like, great, 1,800 point drop, time to buy everything again.
Well, I totally see the point you're making, and I hate to say this, but you are right. I hate to say this, but you are 100% right. I don't think. Let me just make a little differentiation here in my view. The only differentiation I have is I guess what I'm saying is I've become more accustomed to the way that you are now thinking, and the technicals versus the fundamentals, they tend to work better with a shorter time period. So I have indications or indicators and segment levels that tell me based on short time period when it's a good time to enter. So I don't think we're ready yet, but yes, my overall opinion, and I know you were being facetious and you were just throwing that out there as an example, but yes, the truth of the matter is, James, I can't deny it. You're right. It's a trader's market. It's not an investment market. That long-term trend should be moving down, and it may start, but yes, I believe the market is going to rebound. Maybe not tomorrow, maybe not next week, but over the next month or two, we're going to see a strong rebound, and it's going to be the same thing over and over again, just like you said.
Right. So yeah, repeating the actions, expecting a different outcome is certainly the hallmark of insanity. And the market does just that, though. The Fed continues to make the same, repeat the same mistake, so to speak. But the bottom line is, if the Fed's objective is market growth, as demonstrated by stock market performance, then I mean, this is the problem, is that they seem to be, their theory seems to be borne out for all the wrong reasons. That yes, if you just print money, the economy can appear strong because the stock market is strong. But increasingly, even the lowliest taxi driver can see that the economic data does not match the stock performance data in terms of justified performance. And so I mean, but set that aside. That's just not relevant, as our colleague Jeff Zaninieri likes to point out. Who cares whether you're right? It's like, if the market's insane, then get a glove and get in the game, and just be prepared to play an insane game. And that's really that's what I'm thinking. I'm thinking, well, I'm gonna pick up some Tesla today. I'm gonna pick up some probably some Facebook, maybe some, and it's like, and I'm going to buy a few puts on those airlines again and see how much lower they can go.
It is definitely without a question. It is without a question. It is a trader's market, and there's just no way about it. In my opinion, based on my indications in terms of the trading action, what I believe is this. I believe we're going to see more downside based on my momentum levels. I believe the market is going to show more downside, maybe not the next few days, but momentum levels need to cool off. We saw 97% of stocks last week trading above the 50-day moving average. Right now, that number's cooling off. Typically, when that rubber band gets stretched out, James, it likes to go back. It likes to snap back very, very hard before undoing itself again. So in my opinion, we have more downside before moving back up. Also, yeah, that's that's kind of what I was trying to say. Technically, the market moves very differently. It's easier to time the market on a technical levels if you're using technicals versus fundamentals, because you're looking shorter and longer term price levels. And when you're getting those levels, we tend to see overbought and oversold price levels, and that's what I'm focused on right now. And based on 26 years of history, whenever momentals get over 90%, they tend to move back over the next few months back to about 30th percentile. Okay. So right now we're like at 75th percentile. And I believe over the next month, we're going to see some gyrations, some choppiness, maybe not as much optimism as we saw, not till we cool off a little more. That rubber band needs to snap back completely before stretching back out yet. And that's what the momentum levels are really good for. And
sure.
It looks like we're in the 25th percentile. We still have about 70% more to go down in terms of what we saw yesterday before we finally get there.
You bet. So Roger, in the context of trading and technical indicators, are there some indicators that you favor more than others in this kind of a market? For example, you use the concept of the rubber band, and it brings to mind the Bollinger Bands. And Bollinger Bands can be very useful for demonstrating when market excesses have occurred technically in the timeline. And just as the rubber band must be expected to return to its shape. The Bollinger Bands, when they step outside of a given range, can be expected reliably to return to within a band of price. Are there indicators that you favor more in this market?
Yes, and actually, you gave a very good description of the Bollinger Band. That was excellent. I'm impressed. I didn't think you were a Bollinger guy, but
well, you know, Roger, necessity being the mother of invention, I'm finding myself spending more time with a trader's mind than an investor's mind, because I can't see the future on fundamentals anymore, but I can certainly read the tea leaves in the technicals in the immediate time frame.
So, which is very true. So let me tell you, first of all, let me tell you the issue I have with the Bollinger Band, and then I'll tell you the indicators that I'm actually using right now and I've always used for my momentum levels. Bollinger Band is a wonderful indicator. The problem with the Bollinger Band, if you're looking at the overall market, you have the market capitalization issue. That's the biggest beef I have with looking at indexes with technical indicators, because the capitalization always weights in. The top 5, top 10 stocks are going to control the entire market, and it doesn't give you a broad representation. Now, looking at individual stocks through a Bollinger Band and using it the way you just described, in my opinion, is a better way. The way I like to look at indexes is I like to look at them via momentum levels. I like to look at them via the number of stocks trading above the 200-day moving average, above the 50-day moving average in the S&P 500. To me, that's more like opening and looking at it under the hood, because then we're able to look at every stock individually. Because ultimately, those 5 stocks can huff and puff and make a lot of noise. But the truth of the matter is, the overall, they can lead, but the overall market will always control. And the giveaway in this case, starting last week, there was 3 major giveaways, and these happen to be the 3 biggest factors to look at. The percentage of stocks trading above the 200-day moving average was below 50. Even though the S&P 500 was trading above the 200-day moving average, and everybody was saying it's back bullish, if you looked at the internals, the S&P 500 was only about 45% trading above the 200-day moving average. So the long-term trend was down. Second, the number of trading above the 50-day moving average, the median short trend was above 90th percentile, the highest level we've seen in 20 years. Okay, so you have a long-term trend that's down, and you have a short-term trend that's up. And rule number 1 of any pullback system, the short-term trend always moves in line with the long-term trend. It's that simple. So what I saw was a market that the long-term trend was still showing it down, which is what I was saying. A lot of traders are confusing this as a new leg up versus a continuation of the downtrend. Because look, if you're rallying and you still have less than 50% of stocks in the S&P above the 200-day moving average, then you're not in a bull market. You're just in a pullback from a bear market. And that's what it was. The S&P and the overall market was showing this last week immediately prior to the crash. So that was number 1. Momentum levels were not showing me the same thing that the technicals were showing me. That's a big giveaway. The second biggest giveaway, the RSI. You mentioned the Bollinger Band. It's a great indicator. I prefer the RSI. I moved the RSI to 10 days, from 14 days to 10 days. And what I look at is not only when the RSI is above, the RSI oscillator is above 70 or below 30, but I also look to see if there's a divergence between the oscillator and price. In other words, price is going higher, but the highs on the oscillator are lower. We saw that, and we saw that, by the way, in February, immediately before this downturn initially triggered. Exactly the same thing. If you were to see my videos, and I'm not trying to plug them, I'm just letting you know, if you were to look at my videos, morning videos going back a few weeks, every day I was talking about those momentum levels and the divergence. Price action moving higher, but momentum cannot sustain. And that's telling us that momentum levels cannot sustain the momentum we're seeing on price. That's a very, very powerful indicator when you're seeing lower highs on the oscillator and you're seeing higher highs on the price action. Again, we started seeing that last week. And number 3, the put to call ratio. I was even mentioning that on last Friday when we were done, and I went on to ask the pros. I said this is the biggest indication. The put to call ratio on the S&P 500 went below 70, and that's a rubber band waiting to stretch. So there was three, not one, not two, but three major factors that were telling us exactly the same thing that happened in February, leading us into this.
Sure, Roger. Why don't you give me a brief explanation of put to call ratio, because I know that people who are not well versed in options might not be clear on what that means.
It's very simple. It's the total number of open puts in comparison to the total number of open calls. And what we find is it's
Well, put being the right to purchase or the right to sell a stock in the future at a fixed price, and a call being the right to purchase a stock in the future for a fixed price. I'm sorry, I'm going very fundamental on you on
that's
this,
okay.
because it's continuously brought to my attention that people often don't know what the hell we're talking about.
It's okay. And I'll even make it one step easier for you and simpler.
Yeah.
Whenever I say calls, we're always talking about bulls. And when I'm talking in terms of the put to call ratio, and when I'm talking about puts, I'm talking about bears. So when the number of bulls gets so much bigger than the number of bears, okay, the rubber band gets stretched out. It's called a contrary indicator, because what happens is we find that more retail traders trade options than hedge fund traders. So when we see, it's kind of like taking a guy who's never traded before, James, and having him open an account and you taking the opposite of every one of his trades. That's really what the put to call ratio is. It's a contrary indicator that tells us when retail traders are getting way too bullish or way too bearish. Here's the thing. Typically, that indicator, 90% of the time, it's useless. It's random because the numbers are very, very in line. But once a month, every couple of months, you see the stretching effect. And when you see that stretching effect, there's a specific factor, 0.75 or 1.25. So when you see it at 0.75 or lower, that means that the bears are getting so bearish that it's just overwhelming. And when you see retail traders getting so fearful, the market typically flips. Similarly, when you get retail traders extremely greedy, which is what we see when the call ratio gets to 125 or higher, they're getting too greedy. And when that happens, the market turns. As a matter of fact, next time, remind me when we do this, I'll bring a screenshot and I'll highlight the put to call ratio. But this is great. The reason it's great is because even if you don't understand the way you just described options, if people don't even understand options, they don't have to. All they have to understand is there's this rubber band, and it gets to a certain point when retail traders get too greedy. And there's a rubber band that gets too extended when the retail traders get too bearish, too fearful. And the professional trader takes advantage of these levels. So even if you don't trade options, even if you don't understand the mechanism of the options, you can understand greed and you can understand fear and understand when the retail trader gets too greedy, the market turns. When the retail trader gets too fearful, the market turns. And the put to call ratio is the indicator to give us that in a visual and statistical sense without having to read into all of this or really even in-depth options trading.
Mm-hmm. Wow, that's very well put, Roger. Okay, well, let's leave it there for now. So going into, the week is over. We've seen that big correction yesterday. You're suggesting that there is a little bit more pain to be felt. Let's look forward to coming back on Monday. Maybe we'll have, dive in a little bit more on the put to call ratio. And other than that, thanks very much for your input as per usual. Very insightful. And I look forward to speaking to you next week. Have a fantastic weekend, Roger.
Thank you for having me, James.